Appreciate everyone coming today to kind of learn a little bit more about the tax efficient investment planning. For today, we want to kind of talk about tax efficient investment planning. So I would say this is probably one of the biggest parts of my job. When I get a client that comes in, we sit down and we talk a lot about the now. What are we doing now? How do we want to plan? And what do we want to do? And we have goals that we want to get to. But the big piece of that is as we go and we accomplish those goals, we talk about what do the inner working pieces mean and how do you get there? So that's kind of what I want to talk about now is, hey, I'm helping you with your investments. We pick good things, but there's more than that. It's not just about what you earn. It's about what you keep that builds wealth. And what I mean by that is a lot of times people will talk, well, hey, I'm getting a 7 or 8% rate of return on my investments. But depending on the type of investment, you could be paying more taxes on those gains than maybe you could in another investment. So what's the equal piece there? So first thing, obviously, taxes matter. So they can significantly reduce your long-term returns if not managed properly. Now, what I mean by that is over time, depending on what you're doing and what you hold, it can have a big difference because there's something called long-term gains and short-term gains, and what the way those are treated, they're actually treated differently depending on what you own. So if you actually Google or search long-term capital gains, you'll see that there's an entirely different tax rate. Anywhere between 0, 15, I think 20 is the highest. Now there may be one higher, but there's different tiers on how much money you make. And sometimes I tell people you could essentially, if you're showing low enough income and you own stock and you sell it as a long-term gain, you could essentially pay no tax if you fall within the correct bracket. So knowing what you're owning and why you own it is important. A lot of people have mutual funds. You have things called exchange traded funds, and then you have stocks and bonds. There's so many different things out there, and each piece can fit an important spot. But for accounts that you pay taxes on every year, these things matter because you're going to pay taxes on them as you go. So very important to take a look at those and understand what you have. And then you have short-term gains. Those are taxed at ordinary income rates. As we know with taxes, the more you make, the bigger the taxes are because it's a progressive tax bracket. So anything you do that goes above that will put you into the next tier. Understanding tax drag. So I don't know how many people are familiar with what tax drag is. It's exactly as it sounds. It's the drag on your interest from taxes. So the example that I'll give here is, let's say you're making a 7 or 8% rate of return on your investment, but it's taxed at ordinary income. When you actually get those gains, when you realize them, or even when you take money out, the return is actually less because it's taxed at a higher rate than maybe if you held it for over a year. So those can be taxes on interest, dividends, gains. All those are taxed differently. Typically, dividends are taxed at an ordinary income. Interest, you get the bank account at a CD. That's typically ordinary income. And then you have those two different types of gains we just talked about that are important as well. So that'll determine how it's taxed. In addition, we also have things like municipal bonds. Those can be essentially tax-free if you do it the right way. So it's important to understand what you own and why you own it. Asset allocation strategy. So placing the right investments in the right accounts can improve efficiency. So we have a lot of different accounts. So I'm going to kind of explain it this way. So you have what's called qualified accounts. Those are the accounts that give you some of a qualified benefit, whether it's tax deferral, you get to grow them tax-free. So tax deferral would be any type of retirement account that gives you as a traditional. So this could be a traditional 401k, a traditional IRA. And then you have your Roth portion. And I'll explain the difference between the two at the next slide. I'm not going to explain too much here. And then we actually have this magical third account that no one really knows about, but everyone has. And it's what's called a non-qualified account. What a non-qualified account would be is this would be an account that you pay taxes on every year, just like you get issued it's called a consolidated report, usually actually middle of February, where they issue it to you and it explains all the stuff you did, whether there's long-term, short-term, ordinary income and things of that nature. That account you can have as an investment account. You can have at the bank, it could be a CD. It's just non-qualified. And all that means it's a non-retirement account. You're not getting any tax benefits for having that account, and you're required to pay taxes on it either when you sell, every year, depending on what it is, as you get income and things of that nature. Inside of this non-qualified account, which is what we're going to kind of focus on, you can get money out whenever you want. It's important to understand that as you take that money out, you can do this strategy called tax loss harvesting. It's a big thing I talk about people. So let's say that you have a brokerage account at your bank or with me, and you come in and you say, hey, Tim, I have made all this money in this one account and this account didn't do very well. This other investment didn't do well. What we can actually do inside of that account, if they're both stocks, we can actually balance them out and harvest the gains on one and the losses on the other, and essentially balance it out. So my assistant helped me with this, and it's actually a great photo because it shows the balancing. That's what you want to do. You try to realize that you're not showing too much and you're not losing too much. You just want it right in the middle, which avoids tax. Again, the important piece behind this whole thing is putting the investments in the right place. Capital gains planning. So I talked about this briefly about the timing of sales and managing gains help avoid unnecessary taxes. So when you buy a stock or some different things too, when you hold it for longer than a year, it's actually taxed at what's called long-term capital gains. I mentioned this briefly, but it's just the type of tax. If you hold it over a year, it's actually lower in taxes than it would be typically, not all the time, but typically you would pay in your ordinary income bracket. If you sell them within a year, so let's say you buy Apple stock and you hold it for 6 months and you decide you want to sell it, that's going to be sold at short term. If you hold it for longer than a year, it's considered long-term capital gain. It's very important to understand that those are different tax rates. And depending on what you own, sometimes it's okay to realize short-term. Short-term could be dividends. They could be income from a CD. All those things are short-term because they're under a year before you realize them. So just leveraging those. So, hey, maybe I want to wait an extra month to sell this just so I know that it's to be taxed at a better rate. Difference between a Roth and a traditional IRA. So I do a lot of public speaking. I like this one a lot because I'm from Attica. So I like to talk, and I have people in here from Attica as well. I like to talk about growing up in the country. And let's say you're a farmer. Okay. So you go out, you plant all your seed on your farm or corn, whatever it is you're growing, and you get back into your house. You're knock at the door. It's the IRS because they cannot wait to tax you on it. They're going to give you two options. Option one is essentially taxing you now, but once they tax you, they don't care anymore. They got their money. So whatever that crop grows to, they're not going to tax you again, and you sell it, you get whatever it's worth because they already got their money. That's a Roth. Okay. That's tax-free money. You pay the tax now to avoid it later. Secondary option is they're going to say, hey, you know what? If you want, I'll just mark down that you did this. And then in end of the year or whatever that is, when you go to sell it, I'm going to tax you then. That's a traditional IRA, tax deferred. A big question that I get all the time is, Tim, which one is better? I don't have an answer for that because it all depends on you. I know that's kind of a not really an answer, I guess, but it's very important to understand your where you're at, because a traditional IRA can be better if you have higher income now and lower income later. If it's going to be similar, you're almost better doing a Roth. There's a break-even point. The biggest reason why I tell people to have both is because at the end of the day, when you're retired and we could, leverage the different types of assets that we're talking about here for taxes, you may come in and say, hey, Tim, I need 50 grand and you're $20,000 away from the next tax bracket. I may tell you to take out half now so you avoid a lot of taxes because you're going to stay within the lower bracket, and then take the rest from the Roth or the non-qualified, or we take out 20,000 this year or 25 and then $25,000 out the next year. It really all depends on what your situation is. But whenever I do planning, I always talk about the buckets of money approach, just giving yourself as many tools in your belt to do what you can in order to get to the right situation. Tax efficient fund selection. So this is another big one. Some funds are structured to minimize taxable distributions and some aren't. So example here, in your traditional IRA and your Roth IRA, I don't really care what you own as far as the tax aspect goes, because what we're really looking for is whatever is going to do the best in an up and down market. We don't always want to get the best rate of return because we also want to take a look at what the reverse is. That thing's getting the best rate of return, but it's not going to help minimize the back end on the downside. We care about the long-term rates of return. In that same scenario, if you own a mutual fund, they distribute their gains to you when they want because you own a collection. You don't physically own the investments. So they can distribute their gains whatever you want. You can make no money and they could send it out to you whenever they want. The point I'm trying to make here is what you're owning and how you own it is important. Where you're holding it into. I always tell people, talk to your investment, whether you want to talk to me at some point or you have your own person, talk about what you own. Hey, how does this work? How do the taxes work on this? Do I need to be concerned? I'd say 7 times out of 10, you don't need to be concerned, but you will at some point, because at 73, you're required to take out distributions from these accounts in order to pay tax on them, because the government, like we talked about before, they've waited long enough. They want their tax money. And guess what? If you don't take out the correct percentage, I think they lowered it to a 25% penalty now, but there is a penalty for not taking out your what's called a required minimum distribution from those traditional IRAs that are tax deferred, again, to be specific here. And when you take those out, you're required to take out a percentage. Every year that goes up as you get older. So you will have this non-qualified account at some point if you don't spend that money. So it's important to just understand how it works. And I always tell people it's never too late to start on an investment like this, on a non-qualified investment, because it just gives you more flexibility. Common mistakes to avoid: frequent trading. You trade too much. Sometimes that can throw red flags in your investments. Sometimes that can cause you to have a lot of short-term gains, which, again, as we discussed, they're taxed at a higher rate because it's ordinary income. Ignoring taxes. Don't ever do that. You don't want to ignore what the taxes are, how they're taxed. Don't ignore doing your taxes either. That's obviously a big one as well. I have a lot of people that'll say, hey, I don't need to file my taxes anymore, which can be true, but for the $300, have someone double check. Or if you don't have anything, you kind of know, but a lot of times people think they don't have to, and then they take their RMD and they're used to never filing and they realize they actually have to file now. So, and then poor asset placement. can hurt returns. So just understanding what you own, take a look at it. If you've never had anyone help you before, sit down with them and talk to someone about it. I'm always open to chat, whether it's through Zoom, in person in the office, and take a look at what you're doing. We kind of believe here you shouldn't have to feel like you're pressured into something. If I'm the right fit for you, great. If I'm not, no problem. I'll just try to put you in a better spot than when I found you. I'm trying to instill that up on my team and everyone that I'm building in the business and stuff like that with my practice. Putting it all together. So obviously combining all of this stuff together with your planning. So financial planning, retirement planning, whatever your goals are. The idea is you get a lane you want to go down and find the correct path. And then you slowly start to put all these pieces together and incorporate these things because it's going to be more efficient. It's going to lead to longer term growth. It's going to take stress off your plate. I think knowing a little more about what you have and how it's treated and then how we can help. So this obviously is our webinar. So we're going to have a different one every month if you're attending today. There's no one size fits all. You don't meet with someone and you shouldn't be told, hey, every other client did this, so you should do this too. They should really take a look at what you're doing, how it fits into what your goals are, and then we kind of back it in essentially. It's like driving a vehicle and not knowing where you're going. We got to find out what our destination is before we actually get in the car and drive. Good planning obviously is a good foundation for financial confidence and just kind of going from there. In addition to that, if you have any questions and you want to reach out, you can go on our website. On our website, there's a contact us form. You're more than welcome to fill that out if you want to get more info or book a meeting. So let me see if I can open up for questions. What kind of rate are municipal bonds paying? Let me just take a look here. I could take a look really quick. There's different types. So there's treasury bonds. Yeah, I have clients that have the Invesco. It was Oppenheimer. We'll just look at the Vanguard one because that'll be a good reference point. 2.81. So that's the current yield on a intermediate term tax exempt ETF bond through Vanguard. So one we can access and obviously a lot of other options. Just as a reference, I'd say 2.5 to 3%. Obviously don't completely quote me on that, but yeah, but muni bonds are still a good place because if you think about what the tax rate on, so you get 3.5% on a regular dividend, it could be a different type of rate. If you guys have any questions in the future, let me know, and then we'll kind of go from there. So I appreciate it, and I hope you all have a great rest of the evening.